Hey everyone, and welcome to your financial future. Want to know the secret weapon that can make you rich by retirement? Forget fancy brokers or risky day trading. Today, we're cracking the code on ETFs, the simple yet powerful tool that could be your key to unlocking long-term wealth. Ever feel overwhelmed by the stock market? Feeling like Wall Street is a maze you can't navigate? ETFs are here to change that. Imagine a basket full of the best performing companies, all rolled up into one easy-to-buy package. That's the magic of ETFs. But are ETFs really the path to early retirement riches? Can they truly be your secret weapon? Stick around, because in this video, we'll break down everything you need to know about ETFs, from how they work to the best strategies for Gen Z investors. We'll show you how to harness the power of ETFs and build a secure financial future, all before you even hit retirement age. Let's get started. What are the key factors to consider when choosing ETFs for long-term investing as a Gen Z investor? As a Gen Z investor with a long-term horizon, choosing the right ETFs can be a powerful tool for building wealth. Here are some key factors to consider. Investment objective and risk tolerance. Goals: what are you saving for? Retirement: a down payment on a house, or travel experiences? Knowing your goals will help determine your asset allocation, the mix of stocks, bonds, and other investments, within your ETF choices. Gen Z investors may have a higher risk tolerance for long-term goals, allowing for a higher allocation to stocks which have historically offered greater growth potential. Risk tolerance: how comfortable are you with market fluctuations? Understanding your risk tolerance will help you choose ETFs with appropriate volatility. Broad market ETFs that track major indexes tend to be less volatile than those focused on specific sectors or smaller companies. ETF characteristics. Asset class: ETFs can cover a wide range of asset classes, including stocks, bonds, real estate, and commodities. Consider your desired exposure to different asset classes based on your risk tolerance and goals. Expense ratio: this is the annual fee charged by the ETF for managing the underlying assets. Lower expense ratios are better as they eat less into your long-term returns. Gen Z investors, starting early, can benefit significantly from minimizing fees over time. Liquidity: this refers to how easily you can buy and sell the ETF. More liquid ETFs trade frequently throughout the day, allowing for easier adjustments to your portfolio. Underlying holdings: for some investors, transparency in the companies the ETF holds might be important. Some ETFs track broad indexes, while others may be thematic, focusing on specific sectors or investment strategies. Consider if the underlying holdings of the ETF align with your values or investment thesis. Gen Z specific considerations. ESG investing: many Gen Z investors are interested in aligning their investments with environmental, social, and governance (ESG) factors. There are a growing number of ESG-focused ETFs that consider these factors alongside traditional financial metrics. Technological innovation: Gen Z is tech-savvy. ETFs that focus on disruptive technologies or innovation might be of interest, but remember these can be more volatile. Additional tips. Start with broad market ETFs. For beginners, broad market ETFs that track major indexes like the S&P 500 offer instant diversification and a good starting point. Consider all-in-one ETFs. These ETFs offer a pre-mixed portfolio with a variety of asset classes, making them ideal for those seeking a hassle-free, diversified approach. Do your research. Don't just jump into the first ETF that catches your eye. Use reputable financial resources to understand the specific ETF and its holdings before investing. Rebalance regularly. Over time, your asset allocation may drift due to market movements. Rebalancing involves buying or selling ETFs to bring your portfolio back to your target allocation. Invest for the long term. The stock market has its ups and downs, but history shows that long-term investors who stay invested tend to weather the storms and benefit from market growth. How does risk tolerance impact the selection of ETFs for a Gen Z's long-term portfolio? Risk tolerance plays a crucial role in how Gen Z investors should choose ETFs for their long-term portfolios. Here's a breakdown of the impact. Understanding risk tolerance. Risk tolerance refers to your comfort level with potential losses in the stock market. It's essentially a gauge of how much volatility you can stomach. Gen Z investors, generally having a longer time horizon until retirement, can potentially tolerate higher risk compared to those nearing retirement. Risk tolerance and asset allocation. Asset allocation is the process of dividing your investment portfolio among different asset classes like stocks, bonds, and alternatives. Risk tolerance directly influences your ideal asset allocation. High risk tolerance. If you're comfortable with market fluctuations, you can allocate a higher percentage of your portfolio to stocks. Stocks have historically offered the highest potential returns, but also come with greater volatility. ETFs that track broad stock market indexes or specific growth sectors might be suitable. Moderate risk tolerance. A balanced approach might be ideal. Allocate a mix of stocks and bonds. For stocks, consider ETFs that track large-cap companies or dividend-paying stocks, offering more stability. Include bond ETFs for income and portfolio diversification. These can be government or corporate bonds, with varying levels of risk and return. Low risk tolerance. If you prioritize capital preservation, a more conservative allocation with a higher percentage of bonds is appropriate. Choose ETFs that track government bonds or investment-grade corporate bonds, offering lower risk but also lower potential returns. You might also consider including some ETFs focused on income-generating assets like real estate investment trusts, REITs. Risk tolerance and specific ETF selection. Beyond asset class, risk tolerance also influences specific ETF selection within each category. Stocks. For higher risk tolerance, consider ETFs focused on smaller companies or emerging markets, which offer higher growth potential but greater volatility. For lower risk tolerance, choose ETFs that track established blue-chip companies or specific sectors known for stability, like utilities or consumer staples. Bonds. For higher risk tolerance, explore high-yield corporate bond ETFs, offering potentially higher returns but with more credit risk. For lower risk tolerance, stick to government bond ETFs or short-term corporate bond ETFs, offering lower returns but greater stability. The Gen Z advantage. Gen Z's long investment horizon is a significant advantage. They can afford to take on higher risk with a portion of their portfolio, potentially leading to greater long-term returns. However, it's crucial to balance that risk with their overall risk tolerance and investment goals. Are there low-cost, broad-market ETFs well-suited for Gen Z's long-term investment goals? Absolutely, there are several low-cost, broad-market ETFs that are a great fit for Gen Z's long-term investment goals. Here's why they're a good choice. Benefits of low-cost, broad-market ETFs for Gen Z. Long-term growth potential. Broad market ETFs typically track major stock market indexes like the S&P 500 or the total stock market. These indexes have historically provided strong long-term returns, making them suitable for Gen Z investors with a long investment horizon until retirement. Diversification. These ETFs hold a basket of hundreds or even thousands of companies, offering instant diversification across sectors and industries. This reduces risk compared to investing in individual stocks, as the performance of a single company won't significantly impact the overall ETF value. Low fees. many broad market ETFs are passively managed, meaning they simply track an index. This translates to lower expense ratios compared to actively managed funds. Lower fees are particularly beneficial for Gen Z investors with a long time horizon, as every dollar saved in fees compounds over time and boosts returns. Lower volatility. While broad market ETFs still experience market fluctuations, they tend to be less volatile than ETFs focused on specific sectors or smaller companies. This aligns well with Gen Z's long-term perspective, allowing them to ride out market downturns without needing to make panicked investment decisions. Ease of use. These ETFs are readily available through most brokerage accounts and trade similarly to stocks. They offer a simple and convenient way for Gen Z investors to gain exposure to a diversified basket of companies. Examples of low-cost, broad market ETFs. Vanguard S&P 500 ETF, VOO, tracks the S&P 500 index, offering exposure to the 500 largest publicly traded companies in the U.S. Expense ratio, 0.03%, as of June 11, 2024. Schwab U.S. Broad Market ETF, SCHB, tracks the Dow Jones U.S. Broad Stock Market Index, representing the entire investable U.S. equity market. Expense ratio, 0.03%, as of June 11, 2024. iShares Core S&P Total US Stock Market ETF, ITOT, tracks the S&P Total Stock Market Index, encompassing over 3,500 U.S. companies of all sizes. Expense ratio, 0.09%, as of June 11, 2024. Important considerations. While low-cost, broad market ETFs are a great starting point, they may not be the only component of a well-diversified portfolio. Gen Z investors with a higher risk tolerance might consider adding a small allocation to specific sector ETFs or international stock ETFs to further diversify and potentially boost returns. Remember, even low-cost ETFs come with some risk. The stock market experiences ups and downs, and it's essential to maintain a long-term perspective for these investments to reach their full potential. What are the potential benefits of thematic ETFs for Gen Z investors with a long-term outlook? Thematic ETFs can offer some exciting potential benefits for Gen Z investors with a long-term outlook, but it's important to understand both the advantages and potential drawbacks before diving in. Benefits of thematic ETFs for Gen Z. Targeted exposure to growth trends. Thematic ETFs focus on specific themes or industries believed to have high growth potential. This aligns well with Gen Z's long investment horizon, allowing them to potentially capture significant returns from emerging trends. Examples include themes like clean energy, artificial intelligence, robotics, or healthcare innovation. Strong conviction in a particular sector. If Gen Z has a strong belief in a specific industry's future, thematic ETFs offer a concentrated way to gain exposure. This can be a powerful tool for investors who have done their research and understand the potential of a particular theme. Innovation and disruption. Gen Z is a generation that embraces innovation. Thematic ETFs can provide exposure to disruptive technologies and companies at the forefront of change, potentially leading to significant long-term growth. Alignment with values. Many thematic ETFs focus on themes that align with Gen Z's values, such as environmental sustainability or social responsibility. This allows them to invest in companies they believe are making a positive impact while potentially achieving financial goals. Important considerations for Gen Z. Higher volatility. Thematic ETFs tend to be more volatile than broad market ETFs because they focus on a specific sector or theme. This can be a risk, but Gen Z's long investment horizon can help weather these fluctuations. Limited diversification. Thematic ETFs concentrate on a specific area, offering less diversification than broad market ETFs. This can magnify both gains and losses. Newer investment vehicles. Many thematic ETFs are relatively new, and their long-term track record may be limited. This means there's a higher degree of uncertainty compared to established broad market options. Fees. Thematic ETFs can have slightly higher expense ratios than broad market ETFs due to their active management or focus on niche sectors. Should Gen Z investors consider a core satellite portfolio strategy with ETFs for long-term growth? Yes, a core satellite portfolio strategy with ETFs can be a great approach for Gen Z investors seeking long-term growth. Here's a breakdown of why it might be a good fit. Core satellite strategy explained. Core. The core component forms the foundation of your portfolio, typically consisting of low-cost, broad market ETFs that track major indexes or asset classes. This provides stability and diversification through exposure to a wide range of companies and sectors. Satellite. The satellite component allows for targeted investments based on your risk tolerance and specific investment goals. Here, Gen Z investors can explore thematic ETFs or sector-specific ETFs with high growth potential. Benefits for Gen Z investors. Diversification and risk management. The core holding offers broad market exposure, mitigating risk. The satellite portion allows for calculated diversification into specific themes or sectors that Gen Z believes in, potentially boosting returns. Long-term growth potential. By combining a diversified core with potentially high-growth satellite holdings, Gen Z investors can position themselves for long-term wealth creation. Flexibility and customization. This strategy allows you to adjust the core satellite allocation based on your risk tolerance and evolving goals. As Gen Z ages and their risk tolerance potentially changes, they can adjust the satellite allocation accordingly. Cost-effectiveness. Many core ETFs are low cost, and even some thematic ETFs can be relatively inexpensive. This is crucial for Gen Z investors who are likely starting with smaller investment amounts. Alignment with values. Thematic ETFs can allow Gen Z to invest in areas they care about, like clean energy or social responsibility, while still pursuing financial goals. Considerations for Gen Z. Research is key. Understanding the core and satellite ETFs you choose is crucial. Research the underlying holdings, fees, and potential risks involved, especially for thematic ETFs. Rebalancing regularly. Over time, the core and satellite allocations might drift due to market movements. Periodic rebalancing ensures your portfolio remains aligned with your target asset allocation. Long-term commitment. Both core and satellite components are meant for a long-term hold. Avoid making impulsive decisions based on short-term market fluctuations. Example core satellite portfolio for Gen Z. Core, 70% an ETF tracking the S&P 500, BOO, or a total U.S. stock market ETF, SCHB, for broad U.S. market exposure. You might also consider a global stock market ETF for additional diversification. Satellite, 30%. This could include a mix of thematic ETFs based on your interests and risk tolerance. Examples might be a clean energy ETF, ICLN, or a robotics and automation ETF, ROBO. Are all-weather ETFs a viable option for building a recession-resistant portfolio for Gen Z investors? All-weather ETFs can be an interesting option for Gen Z investors looking to build a recession-resistant portfolio, but it's important to understand both the potential benefits and drawbacks before incorporating them into your strategy. What are all-weather ETFs? All-weather ETFs are a specific type of diversified portfolio wrapped into a single ETF. They typically use a rules-based strategy that allocates assets across different asset classes, stocks, bonds, commodities, based on historical market performance during various economic conditions, inflation, deflation, stagflation, growth. The goal is to provide positive returns or at least minimize losses regardless of the prevailing market environment. Potential benefits for Gen Z investors. Reduced volatility. All-weather ETFs aim to offer lower volatility compared to traditional stock market ETFs. This can be attractive for Gen Z investors who are risk-averse or want to hedge against potential recessions during their long investment horizon. Diversification. These ETFs offer exposure to a variety of asset classes, potentially mitigating risk associated with any single asset class underperforming. Simplicity. They provide a one-stop solution for diversification, potentially appealing to Gen Z investors who are new to investing or prefer a hands-off approach. Important considerations for Gen Z. Limited upside potential. While all-weather ETFs aim to minimize losses during downturns, they may also limit potential returns during strong market upswings. Gen Z investors with a long horizon might sacrifice some growth for stability. Fees. Some all-weather ETFs have higher expense ratios compared to traditional broad market ETFs. This can eat into returns over time. Not recession-proof. While aiming for resilience, all-weather ETFs cannot guarantee positive returns during recessions. Historical performance may not be indicative of future results. Less transparency. The specific allocation within the ETF might be more complex compared to a traditional broad market ETF, making it harder for Gen Z investors to understand their underlying holdings. All-weather ETFs versus poor satellite strategy. Poor satellite strategy, explained previously, offers more flexibility and customization. You can choose a low-cost broad market ETF for the core and add a small allocation of a bond ETF or other asset classes for the satellite portion, potentially achieving similar diversification with more control. How does international diversification with ETFs benefit Gen Z's long-term investment strategy? International diversification with ETFs offers several significant benefits for Gen Z's long-term investment strategy. Here's a breakdown of the key advantages. Reduced risk through diversification. Market correlation. Stock markets worldwide aren't perfectly correlated. When the US market slumps, international markets might perform better, and vice versa. By including international ETFs, Gen Z investors spread their risk across different economies, reducing the impact of a downturn in any single market. Exposure to different growth opportunities. Emerging economies often experience faster growth rates than developed markets. International ETFs provide access to these high-growth potential markets, potentially boosting returns over the long term. Industry concentration. The U.S. economy is heavily concentrated in certain sectors like technology. International diversification offers exposure to different industries that might be dominant in other countries, like resources or manufacturing. This reduces reliance on the performance of a single sector. Benefits specific to Gen Z investors. Long investment horizon. Gen Z has a long time horizon until retirement. This allows them to ride out short-term market fluctuations and benefit from the potential of international markets over the long term. Globalized world. Gen Z is a generation that understands the interconnectedness of the global economy. International diversification aligns with this perspective and allows them to participate in the growth of companies worldwide. Examples of international ETFs for Gen Z. Vanguard FTSE Developed Markets ETF, VEA, tracks the performance of developed markets excluding the U.S. Vanguard Emerging Markets ETF, VWO, tracks the performance of companies in emerging economies. iShares MSCI International Diversified UCITS ETF, USD, provides broad exposure to developed and emerging markets outside the U.S. When comparing ETFs and mutual funds, which is more suitable for Gen Z's long-term wealth building? Here's a breakdown of ETFs versus mutual funds to help Gen Z investors decide which is more suitable for long-term wealth building. Exchange-traded funds, ETFs. Transparency: ETFs hold a basket of securities that are publicly disclosed. Gen Z investors can easily research the underlying holdings of an ETF. Tax efficiency: ETFs typically trade throughout the day, similar to stocks. This allows for more tax-efficient transactions compared to mutual funds, which can generate capital gains distributions that may trigger taxes for investors. Lower fees: many ETFs are passively managed, tracking a specific index. This translates to lower expense ratios compared to actively managed mutual funds. Lower fees have a significant impact on returns, especially for Gen Z with a long investment horizon. Flexibility: ETFs can be bought and sold throughout the trading day, offering more flexibility for Gen Z investors who might want to adjust their portfolio more frequently. Mutual funds. Professional management: mutual funds can be actively managed by professional fund managers who aim to outperform the market. This might be appealing to Gen Z investors seeking potentially higher returns, but past performance is not a guarantee of future results. Investment minimums: some mutual funds have minimum investment requirements, which might not be ideal for Gen Z investors starting with smaller amounts. Potential for higher fees: actively managed mutual funds tend to have higher expense ratios compared to ETFs. Gen Z and long-term investing. Considering the above points, ETFs tend to be a more suitable option for Gen Z's long-term wealth building for several reasons. Cost-effectiveness: lower fees in ETFs compound over time, leading to potentially greater returns for Gen Z with a long investment horizon. Transparency and control: ETFs offer transparency and allow for more control over investment decisions. Gen Z investors can research the underlying holdings and make informed choices. Flexibility: the ability to buy and sell throughout the day allows for more flexibility, potentially aligning with Gen Z's comfort level with managing their portfolio. How do robo-advisors stack up against ETFs for Gen Z investors seeking a long-term approach? Both robo-advisors and ETFs offer advantages for Gen Z investors with a long-term outlook, but they cater to different needs and preferences. Here's a breakdown to help you decide. Robo-advisors. Automated investing: robo-advisors create and manage diversified portfolios based on your risk tolerance and investment goals through an automated algorithm. This can be a great option for Gen Z investors who are new to investing or prefer a hands-off approach. Convenience and simplicity: robo-advisors handle most investment decisions, rebalancing, and paperwork, making investing convenient and easy to manage. This can be attractive for busy Gen Z individuals. Fractional shares: many robo-advisors allow investing with fractional shares, enabling Gen Z investors to start with smaller amounts and invest in expensive ETFs more easily. Potential drawbacks for Gen Z. Limited control: robo-advisors dictate the asset allocation and specific ETFs within your portfolio, offering less control over investment choices compared to selecting your own ETFs. Fees: robo-advisors typically charge an annual management fee, usually a percentage of your assets under management, AUM. These fees can eat into returns, especially for Gen Z investors starting with smaller portfolios. While some robo-advisors have lower fees, they might offer fewer features. Limited customization: while robo-advisors offer some customization based on risk tolerance, they may not cater to very specific investment goals or thematic interests that Gen Z investors might have. ETFs. Lower fees: many ETFs, particularly broad market ETFs, have very low expense ratios. This is crucial for Gen Z with a long investment horizon, as lower fees translate to potentially higher returns over time. Greater control: Gen Z investors have complete control over choosing specific ETFs that align with their investment goals, risk tolerance, and any thematic interests they might have. This allows for a more personalized portfolio. Transparency. ETFs offer complete transparency regarding the underlying holdings. Gen Z investors can research the specific companies within an ETF before investing. Potential drawbacks for Gen Z. Research required. Selecting the right ETFs requires research and understanding of different asset classes and investment strategies. This can be time-consuming for Gen Z investors who are new to investing. Rebalancing responsibility. Rebalancing a portfolio with ETFs requires manual effort to maintain your target asset allocation. This can be an additional responsibility for Gen Z investors. Trading fees. Some brokerages charge trading fees for buying and selling ETFs. These fees can add up over time, especially for Gen Z investors who make frequent trades. Who should use what? Robo-advisors are ideal for Gen Z investors who are new to investing and prefer a hands-off approach. Busy individuals who don't have time for extensive research and portfolio management. Those starting with smaller investment amounts who can benefit from fractional shares. ETFs are ideal for Gen Z investors who are comfortable with research and want more control over their portfolio construction. Those who prioritize low fees and long-term growth. Investors with specific investment goals or thematic interests that they want to incorporate into their portfolio. What are some common mistakes to avoid when selecting ETFs for long-term investing as a Gen Z investor? Here are some common mistakes to avoid when selecting ETFs for long-term investing as a Gen Z investor. 1. Chasing trends and hot sectors. Focus on long-term, don't get caught up in the hype of the latest hot sector or trendy thematic ETF. Remember, you're investing for the long haul. Focus on ETFs that provide broad diversification and align with your overall investment goals. 2. Ignoring risk tolerance. Understand your risk. Gen Z investors might be tempted by high growth potential, but it comes with higher risk. Choose ETFs that match your risk tolerance. If you're risk-averse, prioritize broad market ETFs with lower volatility. 3. Not diversifying enough. Spread the risk, don't put all your eggs in one basket. Invest in a variety of asset classes and sectors using ETFs. This helps mitigate risk if a specific sector underperforms. Consider a core satellite strategy for a balanced approach. 4. Focusing solely on expense ratio. Look beyond fees. While expense ratios are important, especially for long-term investing, don't solely focus on the cheapest option. Research the underlying holdings and the overall strategy of the ETF before investing. 5. Overlooking underlying holdings. Know what you own, don't just invest in an ETF because it sounds interesting. Research the specific companies or assets within the ETF to understand what you're actually buying. 6. Ignoring rebalancing. Maintain allocation. Over time, the weightings of your ETFs might drift due to market movements. Periodically rebalance your portfolio to ensure it stays aligned with your target asset allocation. 7. Panic selling during downturns. Long-term perspective. Market downturns are inevitable. Gen Z investors have a long horizon. Don't panic and sell your ETFs during these periods. Stay invested and ride out the volatility. 8. Checking your portfolio obsessively. Invest and forget, don't check your portfolio every day. Constant monitoring can lead to emotional decisions. Invest for the long term and review your portfolio periodically to rebalance or adjust your strategy as needed. 9. Not considering robo-advisors. Explore all options. Robo-advisors can be a great tool for Gen Z investors who are new to investing or prefer a hands-off approach. They offer automated portfolio management and diversification. 10. Not seeking professional guidance. Get help if needed. If you're unsure about selecting ETFs or building a portfolio, consult with a financial advisor. They can provide personalized advice based on your specific goals and risk tolerance. Is it beneficial to rebalance a portfolio of ETFs over the long term for Gen Z investors? Absolutely, rebalancing a portfolio of ETFs can be very beneficial for Gen Z investors over the long term. Here's why. Benefits of rebalancing for Gen Z. Maintains target asset allocation. As markets fluctuate, the weightings of your ETFs can drift away from your original target asset allocation, for example, 70% stocks, 30% bonds. Rebalancing brings it back into alignment, ensuring your risk profile remains consistent with your goals. Enforces discipline. Regular rebalancing can prevent emotional investing decisions. When a specific ETF outperforms, it might be tempting to hold on to it for continued gains. Rebalancing forces you to sell some of that outperforming asset and potentially buy more of the underperforming ones, adhering to your long-term plan. Capitalizes on reversion to the mean. Historically, asset classes tend to revert to their long-term average returns over time. Rebalancing allows you to buy low when an ETF underperforms and sell high when it outperforms, potentially boosting your returns. Reduces risk. Maintaining a diversified portfolio through rebalancing helps mitigate risk. If a particular sector or asset class experiences a downturn, the impact on your overall portfolio is lessened. What are the emotional aspects to consider when choosing ETFs for a long-term investment plan as a Gen Z investor? Gen Z investors are entering the market at a unique time, with a lot of information and potentially strong emotional ties to certain investment themes. Here's a breakdown of some key emotional aspects to consider when choosing ETFs for a long-term investment plan. Fear of missing out, FOMO. Focus on long-term goals. Don't chase trendy themes or hot sectors solely because everyone else seems to be doing it. Remember, you're investing for your future, not overnight gains. Choose ETFs that align with your long-term goals and risk tolerance. Excitement and overconfidence. Manage expectations. Don't expect astronomical returns right away. The stock market has ups and downs. ETFs offer a path to wealth building through long-term growth, not a get-rich-quick scheme. Desire for control and immediate results. Embrace the long game. Investing is a marathon, not a sprint. While ETFs offer some level of control through choosing specific ones, understanding that results take time is crucial. Avoid checking your portfolio constantly and focus on staying invested for the long term. Environmental, social, and governance (ESG) concerns. Align investments with values. Gen Z is passionate about social and environmental issues. Consider thematic ETFs that focus on sustainable practices or social responsibility if these values are important to you. However, ensure they also align with your overall investment goals. Frustration with market volatility. Develop a risk tolerance. Market downturns are inevitable. Prepare yourself emotionally for volatility. Having a diversified portfolio with ETFs helps mitigate risk, but some ups and downs will occur. Don't panic sell during these periods. Can ETFs be a suitable investment vehicle for Gen Z's retirement savings goals? Absolutely, ETFs can be a suitable investment vehicle for Gen Z's retirement savings goals, and here's why. Benefits of ETFs for retirement savings. Long-term growth potential. ETFs, especially broad market ones, offer exposure to a variety of stocks and bonds. This diversification helps capture long-term market growth, crucial for retirement savings with a distant time horizon. Low fees. Many ETFs, particularly passively managed ones, have low expense ratios. This translates to potentially higher returns over the long term compared to mutual funds with higher fees. Lower fees are even more impactful for Gen Z investors who have a long time horizon for their retirement savings to compound. Diversification. ETFs allow for diversification across asset classes and sectors, reducing risk. This is important for retirement savings, as you don't want to be overly exposed to any single company or sector. Flexibility. ETFs offer flexibility within a retirement account. You can choose broad market ETFs for a core portfolio allocation and potentially add a satellite allocation of thematic ETFs that align with your interests. Transparency. ETFs hold a basket of securities that are publicly disclosed. This allows Gen Z investors to research the underlying holdings and understand what they're invested in. Considerations for Gen Z investors. Risk tolerance. While ETFs offer diversification, some are inherently riskier than others. Choose ETFs that align with your risk tolerance as you approach retirement. Gradually shift your portfolio towards more conservative options, bonds, as you near retirement age. Time horizon. Gen Z has a long investment horizon until retirement. This allows them to ride out market fluctuations and benefit from the potential of ETFs over the long term. However, as you get closer to retirement, consider adjusting your portfolio to a more conservative asset allocation. Investment strategy. Develop an investment strategy for your retirement savings using ETFs. Consider a core satellite approach or consult with a financial advisor to create a plan tailored to your specific goals and risk tolerance. Examples of ETFs for retirement savings. Broad market ETFs, SPY, SPDR S&P 500 ETF, VOO, Vanguard S&P 500 ETF, VTI, Vanguard Total Stock Market ETF. Bond ETFs, BND, Vanguard Total Bond Market ETF, AGG, iShares Core US Aggregate Bond ETF. Alright, that's a wrap on the amazing world of ETFs for Gen Z investors. Remember, ETFs are a marathon, not a sprint. They're all about harnessing long-term growth for a secure retirement future. So, what's your next step? First, do your research. Explore different ETFs, understand their underlying holdings, and choose ones that align with your risk tolerance and goals. Don't be afraid to seek help from a financial advisor if you need personalized guidance. Finally, the most important step, take action. Start investing early, even with small amounts. Remember, with ETFs, time is your greatest ally. The sooner you start, the more your money has the potential to grow. So, are you ready to unlock your retirement riches with ETFs? Thanks for joining me on this journey to financial freedom. Leave a comment below and let me know what questions you have about ETFs. Don't forget to like this video and subscribe to the channel for more awesome financial tips for Gen Z. See you next time.